trade? Where would you set your stop loss? These are all some questions you should be asking yourself. What I see a lot of beginners doing is they will do the obvious. That is, they set the entry point right above the white line and they set their stop loss below the strong support. Then, of course, they set their take profit target at the strong resistance, giving them a 2.73 profit ratio. Now, as I'm saying this, you might be thinking, well, I don't see anything wrong with the strategy. The key concept this specific trader is missing is the concept of getting the most out of your risk reward ratio. This person is getting $2.72 for every dollar they raise, which isn't bad, but it can be a lot better. Let me show you how. You're going to keep the exact same support, resistance, and take profit. The only thing we're going to add to the strategy is a little bit of patience. One of my all-time favorite quotes in trading is that trading is patient people taking money from impatient people. And it's so goddamn true. Instead of entering when the price breaks through a white resistance line, we're going to wait for a pullback to happen and bounce off of it. You might be saying to yourself, why would we wait for a pullback if we're entering at the same exact price anyways? And the answer is taking advantage of your risk to reward ratio. We are not able to set our stop loss below the white line because there's not enough key points to make this a strong enough support. Sure, there's a couple, but not enough to make it a strong one. But if a pullback happens and bounces off the white line, we can now consider that line as a strong support and set our stop loss below that rather than the red line. Let me show you what I mean. So instead of entering when the price breaks through the white line, we're going to be patient and wait for a pullback to happen. Wait a bit and see if a pullback occurs. This is extremely good news because one, the price respects this new level, goes off, and two, creates a couple more key points, making this a more reliable level. Why this is important is because we are now raising stop loss below this level. We were not able to do that before because it was not strong. But now that we see it's reliable, we can do so. We now have our stop loss below the white line. We are going to keep our take profit, the green line, at the exact same spot. Now, the next thing you might be asking, we are not, why this is important is because we can now raise our stop loss below this level. We were not able to do that before because it was not strong. But now that we see it's reliable, we can do so. We now have our stop loss below the white line. We're going to keep, hold on.
So that nigga wait for it to bounce back. That don't make
For a
sense.
pullback to happen. Wait a bit and see a pullback occurs. This is extremely good news because one, the price respects this new level, bounces off, and two, creates a couple more key points, making this a more reliable level. Why this is important is because we can now raise our stop loss below this level. We were not able to do that before because it was not strong. But now that we see it's reliable, we can do so. We now have our stop loss below the white line. We are going to keep our take profit, the green line, at the exact same spot. Now, the next thing you might be asking is, all right, we moved our stop loss up. What's the big deal? The big deal is now that we raised our stop loss up a considerable amount, instead of having a 2.86 profit ratio, we now have a 6.1 profit ratio, almost 3 times the amount we had before. So now we're getting $6.10 for every dollar we're risking compared to $2.86. Even though we're making the same amount of money as we were before, considering that we didn't move our take profit, we now have a way higher risk to reward ratio, which will help us out so much in the long run. I know it's a slightly confusing topic, but it's such a crucial thing to understand when you first start trading, and it'll definitely pay off throughout your trading career. The next crucial tip I want you to understand is the powerful concept of knowing how much money to risk per trade. I see all these financial gurus on YouTube or Wall Street Bets telling you ways to double or triple your account within 24 hours. While the profits may seem very glorious and heavenly, profit percentage is not everything. It's all about the amount of successful quality trades you make. So Trader One is the YouTube guru that I was talking about before. We gave them a starting balance of $100. They have a profit target of 20% per trade, which is one, not only risky, but you're going to find way less trades like that per month. So in this example, I have them taking 6 trades per month. So this is saying if all 6 of these trades were successful, which I'm not even including any risk, and even finding 6 trades a month with 20% profit is pretty hard, but we'll give them the benefit of the doubt. This specific trader would have made $298. Then we have Trader 2. We also gave them $100, but we're setting their profit target at 3%. This is not only way less risky, this trader will be able to complete a lot more trades. So this trader was able to find 150 successful trades per month because the profit target was so much lower and doable. Even though Trader 2's profit ratio was 10 times lower, they still made $1,950. The key concept I want you to take away from this is you shouldn't be worried about how high your profit percentage is. You should be worried about consistency and the amount of successful trades you can accomplish. My third and final concept I want to share with you guys to help you grow a small stock account has to do with risk. Let me explain. So going back to the trader who risked 20% of their account per trade, even though they would make 20% if they won, they're still risking 20% if they lost. If you're risking high percentages per trade, you're better off going to a casino gambler because that's basically what you're doing. If you truly want to grow your account, you have to aim for longevity and consistent profits. The reason trading with high risk is a problem is because of consecutive losses. I don't care how good your trading strategy is, every strategy is going to have consecutive losses. If you have 5 to 7 losses in a row and you're risking 20% per trade, your portfolio is going to go down the gutter quick. This is exactly why it's recommended that you risk 1 to 2% per trade. Let me show you why. This is a trading simulator. So in this example, we're going to start with $1,000, have a win probability of 60%, have 2 wins for every loss,
Like 10 minutes onwards.
and
You good, baby?
we're going to risk
Okay.
20%.
Take your time.
You
The
open
key
me
stat
now?
we're looking at is the biggest max drawdown. If you take a look at this, if we were to risk 20% per trade, we have the potential to lose 90.4% of the
No,
portfolio
stop.
gone, which is absolutely crazy. Could you handle a 90.4% drop in your portfolio? And that's just with 20%. Let's see what 50% looks like. Now take a look at the drawdown. 100%. The average is 99.7. But take a look at if we just risked 2% per trade. The biggest amount we could lose is 15.5% of our account. Now, if you want to double or triple your account within a week, you're not going to get there trading 1 to 2%, or even 10%. You have to risk a lot to get high returns like that. I realize that not everyone has the same risk tolerance. Some of you may have a higher risk tolerance than others. Some of you may have more money to risk. That's okay. But if you truly want to grow your account efficiently, are in the trading game to make consistent profits, and are in it for the long haul, it has been statistically proven that trading with 1 to 2% of your account is the best way to do that. If you're only risking 1 to 2%, you can handle a lot more consecutive losses compared to 20 or 50%. Which, if you're trading for the long term, you're gonna have a period of time where you're gonna get 5 to 9 bad trades in a row. When I'm trading, I want the math to work with me, not against me. That's exactly why I and many others use the 1 to 2% trading strategy. I just showed you 3 different tips to help you grow a small trading account. All I ask in return is if you take 2 seconds out of your day and like this video. If you want to grow a small trading account, you're going to need a good trading strategy. Well, good thing for you, I made a video where I show you an insanely profitable trading strategy that is proven to work. Go check that out. Thanks for watching, and I'll see you guys next time. Let's get straight to the point. The markets are manipulated against you. Every single day, the market is manipulated in some type of way, and it's meant for the average retail investor like you and me to lose money. If you are losing money, it's by design, not by luck. While your balance is going down, billionaires and hedge funds are making millions. How do these hedge funds manipulate markets? How can I tell when a market is being manipulated? How do I take advantage of these manipulated markets so I myself can make money? Well, those are all good questions, and it's exactly what we're going to be talking about. Let's get straight to it. Market manipulation, the act of artificially inflating or deflating the price of a security or otherwise influencing the behavior of the market for personal gain. There are tons of styles of manipulation, and the scary part is some of the ways are completely legal. The first style of market manipulation is one that almost everybody knows about, but it's important I cover it because you do need to know to the extent of what's going on. News manipulation. This is one of the most common types of market manipulation, and it's happening almost every single day right in front of your eyes. You getting on your computer creator going on Reddit and making up a story and creating a thread why company XYZ is such a bad company is market manipulation. You being down 30% because the stock you recently invested in went down, then you think you can go on StockTwits and make a false story so others invest in that company is market manipulation. But this is purely just level 1 for market manipulation, and it's usually a lot easier to spot than higher levels. Hedge funds will use techniques that are a lot more subtle and harder to spot. So let's say there's $1 billion hedge fund. It wants to buy a ton of shares from a company that's $20 per share, but they think it's worth 40. The thing is, they can't just go out there and accumulate millions of shares all at once, because it would affect the market drastically, making the price have a huge spike. That's the one thing these massive investors and hedge funds have to think about all the time. Since they're dealing with huge amounts of money, they not only have to think about company valuations, but also how their entries will affect the market. This is usually how the strategy goes. When the market of a particular stock that they are targeting is very weak, the hedge funds will slowly accumulate shares. They do this in sessions, not all at once. This way, they still get the huge amount of shares they want without affecting the market too much. Let's fast forward in time and say that specific stock they invested in is now worth $40. The hedge fund knows that this company is not that good, and a $40 stock price is pretty much as high as it's going to get in the near future. So they want to exit their position. Unlike you and me, where we can simply just sell our shares right then and there, hedge funds again have to do a more advanced approach. They have so many shares that there are simply not enough buyers to fill all their sell orders at the specific price they want. If they want to sell all their shares at a high price, they're going to need more buyers. So how can they dump millions of shares of stock at a great price unnoticed in a few weeks and get away with it? Manipulation. This is how they do it. But first, let's go over this video's sponsor, Robinhood. Now, I know what you're thinking.
Oh no, not another ad.
But this one may just help your investing game. So as we all know, during the making of this video, the stock market is going down. Instead of trying to figure out the exact bottom, the great strategy for long-term investors is dollar cost averaging. It's basically when you invest a fixed dollar amount on a regular basis.
You said what?
With the current
Play the game.
Yeah, I couldn't know while I'm watching my investment video.
Oh wow.
Oh wow, what, man?
market is doing. Capitalize can automate this process for you by making an automatic trading bot. Just simply go to the strategy creator, type buy 5,000 USD worth of Apple after 30 days from entry starts, and set the strategy on a loop. And every 30 days, the bot will automatically buy $5,000 worth of Apple. It's really that simple. This is really just the tip of the iceberg with this. You can code any bot you would like, and it can get extremely advanced. The best part is, you don't need any coding experience. If you're interested in creating a bot, I'll leave a link in my description. Back to the video. So we went over how the average investor would manipulate the market, but how do hedge funds manipulate the market? They do it the same type of way as you and I would in the example I used before, by going on Reddit and giving a big catalyst. But they sort of have a billionaire version of it. They do have the same idea though. Create some FOMO, fear of missing out, and get people to think that this $40 stock is going to be the next Amazon. They're going to make you think that if you don't enter right at this very moment, you're going to miss out on huge gains. Except instead of just making a little post on Reddit, they have a greater source to spread misinformation: news outlets. When the pandemic hit, it was a huge hit to the economy and a lot of media stations. More than 70 local news outlets closed due to the crisis. It's an estimate that a staggering 2,100 newspapers, or 1 in 4, have closed in the US since 2005. But as all this chaos breaks out, hedge funds and private equity firms look at this as an opportunity, buying up all these dying news outlets and using them to send out reports for their own investments. Hedge funds or private equity firms now control half of US daily newspapers. And you know what they do with them? Spread FOMO. This almost acts as a snowball effect. Think about it. The huge media outlet creates the FOMO story. Then, all these retail investors jump on the bandwagon, creating almost a snowball effect. In a way, the retail investor is doing all the work for the hedge fund, because after they enter their position, they start spreading the FOMO news themselves to all their friends or even the internet, because they want the stock to go up from where they enter. And it basically just keeps getting recycled from one investor to the next. All this news is going to bring huge amounts of volume, so the hedge fund can sell their position as quickly and, most importantly, at the price they want. They don't care if the stock goes up 20% from all the big news. They really only care about exiting their position at this point. And guess what? When everyone starts to realize